Every day, millions of people jump into the stock market hoping to make easy money. Yet most end up losing. Why? It's not because the market is rigged or investing is impossible. The real reason is that most people let emotions control their decisions, buying out of greed, selling out of fear, and chasing trends without a strategy. In this video, we'll break down the biggest mistakes investors make and how smart investors avoid them. Today we will talk about why most people lose money in the stock market. So before we start, make sure to hit the like button and subscribe to my channel. 1. Lack of financial education and knowledge. One of the biggest reasons people lose money in the stock market is the lack of proper financial education. Many beginners invest without understanding how the market actually works. They do not know how to read financial statements, evaluate company performance, understand market trends, or analyze risk. Instead of learning the basics, they rely on random advice from friends, social media influencers, YouTube videos, or online forums. This creates dangerous situations where investors buy stocks simply because someone else claims they will rise. Most new investors also fail to understand the difference between investing and gambling. Investing requires research, patience, and long-term thinking, while gambling depends mainly on luck and emotions. People often buy stocks based on hype without understanding the company's business model, earnings, debt levels, or future growth potential. When the stock price suddenly falls, panic begins, and they sell at a loss. Financial literacy is extremely important in the stock market because the market rewards informed decisions. Successful investors spend years learning about economics, company valuation, risk management, and investor psychology. Without education, people become vulnerable to scams, misleading information, and emotional decision-making. Lack of knowledge leads investors to make poor choices repeatedly, eventually causing significant losses over time. 2. Emotional investing, fear, and greed. Human emotions play a massive role in stock market losses. Fear and greed are the two strongest emotions that control investor behavior. When a market is rising rapidly, greed convinces people that prices will continue increasing forever. Investors become overconfident and start buying stocks at extremely high prices because they fear missing out on profits. This behavior is commonly known as FOMO, or fear of missing out. That, on the other hand, when the market begins falling, fear takes control. Investors panic and sell their stocks quickly to avoid further losses. Ironically, many people buy when prices are high and sell when prices are low, which is the exact opposite of successful investing. Emotional investing destroys rational thinking and leads to impulsive decisions. Market volatility is normal, but inexperienced investors often react emotionally to short-term price movements. News headlines, economic uncertainty, political events, or sudden market crashes create fear among investors. Instead of focusing on long-term goals, they focus on temporary losses. Emotional decisions often result in selling quality investments too early or buying risky stocks during market hype. 3. Chasing quick profits and unrealistic expectations. Another major reason people lose money is the desire to become rich quickly. Many investors enter the market expecting fast profits within days or weeks. Social media has increased this problem significantly because people constantly see screenshots of huge profits, luxury, lifestyles, and viral success stories. These stories create unrealistic expectations and encourage risky behavior. In reality, successful investing is usually a slow and long-term process. Building wealth through the stock market often requires years of disciplined investing, consistent contributions, and patience. However, many people become impatient and start chasing hot stocks, penny stocks, or speculative investments that promise massive returns. These investments are often highly volatile and dangerous. Day trading and options trading also attract many beginners who believe they can make easy money quickly. While some professional traders succeed, most inexperienced traders lose money because they lack the skills, experience, and emotional discipline required for short-term trading. 4. Lack of risk management. Risk management is one of the most important skills in investing, yet most people completely ignore it. Many investors put too much money into a single stock, industry, or risky investment without considering potential losses. This lack of diversification creates enormous financial danger. For example, some people invest all their savings into one trending technology stock or cryptocurrency because they believe it will continue rising forever. If the investment collapses, they lose a significant portion of their wealth. Diversification exists to reduce risk. By spreading investments across different sectors, industries, and asset classes. Another common mistake is investing money that people cannot afford to lose. Some investors borrow money, use emergency savings, or invest funds needed for short-term expenses. When the market falls unexpectedly, financial pressure forces them to sell investments at a loss. Many people also fail to use proper position, sizing, and stop-loss strategies. 5. Following the crowd and market hype. Crowd behavior is another major reason why investors lose money. Humans naturally follow others during uncertain situations, and this behavior becomes extremely dangerous in financial markets. When everyone is talking about a specific stock or investment opportunity, people assume it must be profitable. As a result, they blindly follow trends without doing independent research. This behavior creates market bubbles where stock prices rise far beyond their actual value. Eventually, reality catches up, prices collapse, and late investors suffer heavy losses. History provides many examples of market bubbles, including the dot-com bubble, housing market crash, and speculative meme stock surges. Social media platforms have amplified market hype dramatically. Influencers often promote stocks to gain attention, followers, or personal profits. Many inexperienced investors buy stocks based solely on viral trends, online discussions, or celebrity endorsements. 6. Poor patience and lack of long-term thinking. Patience is one of the most valuable qualities in investing, yet it is extremely rare. Many people expect immediate results and become frustrated when investments do not rise quickly. As a result, they constantly buy and sell stocks instead of allowing investments enough time to grow. The stock market experiences regular ups and downs. Short-term volatility is completely normal. However, investors who focus only on daily price movements often make poor decisions. They panic during temporary market declines and miss the long-term growth potential of strong companies. Compounding is one of the most powerful forces in investing. Long-term investors benefit from years of growth, dividends, and reinvestment. 7. Overconfidence and ignoring professional advice. Overconfidence is another dangerous problem in the stock market. After making a few successful trades, many investors begin believing they are experts. They assume their profits are due to skill rather than luck. This false confidence often leads to larger risks, careless decisions, and eventual losses. Overconfident investors frequently ignore professional advice, economic warnings, or risk management principles. They believe they can predict market movements accurately and consistently outperform the market. In reality, even professional fund managers and analysts struggle to predict short-term market behavior. Some investors also refuse to admit mistakes. Instead of cutting losses early, they continue holding failing investments because they believe the market will eventually prove them right. This behavior can turn manageable losses into catastrophic financial damage. Humility is extremely important in investing. But if you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.